faithfully delivering value, interpreting the world's best books. Hi, this is Sally's Book Talk. Today, I'm interpreting the 5 rules for successful stock investing. The book's author, Pat Dorsey, is the head of equity research at Morningstar, a famous U.S. fund rating agency responsible for stock analysis and ratings. He has extensive professional experience in securities analysis. The concepts and methods introduced in Dorsey's The 5 Rules for Successful Stock Investing all come from value investing masters like Graham and Buffett. This book helps investors quickly establish a clear value investing analysis framework that can be directly applied to investment practice. Moreover, the author presents investment knowledge in a way that's deep yet easy to understand. If you're learning how to invest, this book is undoubtedly a highly practical textbook. Even professional investors with rich experience can benefit greatly from it. Next, I'll interpret this book in 4 parts. Part 1 introduces the core concepts of value investing. Part 2 discusses how to analyze a company's fundamentals. Part 3 covers how to value a company. Part 4 introduces key investment points for major industries. First, Part 1, the core concepts of value investing. When investing in stocks, having the right concepts and methods is key to success. There are many popular investment methods in the stock market, such as technical analysis, momentum, investment systems, trading, quantitative investing, and so on. And in the long run, most of these methods don't effectively help you make money. But one method has stood the test of a century of stock market practice and proven to be effective in the long term. That is value investing. Value investing was founded by Graham and has historically produced a group of outstanding investment masters. Warren Buffett, the stock god, has always adhered to and advocated value investing throughout his life. Value investing can be summed up in one sentence: buying stocks is buying a company. Value investing involves making value judgments about a company from the perspective of a business owner. Its investment logic is that stocks represent ownership in a business. If the business operates well and can consistently make money, its value increases, and its stock price naturally rises accordingly. Peter Lynch, a famous U.S. fund manager, has a brilliant conclusion. In the short term, stock prices may have no relation to company performance. But in the long term, company operating performance and stock price are 100% correlated. In the long run, the actual performance of stock prices indeed reflects this. So how should one practice value investing? The author summarized 5 principles. First, do your homework. Second, look for companies with strong competitive advantages. Third, invest with a margin of safety. Buy cheap enough. Fourth, hold long-term after buying. Fifth, know when to sell. These 5 principles cover the entire investment process: buying, holding, and selling.
First, before buying, do your homework. That means thoroughly understanding and researching your investment target, like studying the company's annual reports, learning about industry competitors, etc. Spending more time preparing reduces mistakes.
Next is stock selection. Value investing buys companies with strong competitive advantages. In other words, find companies with strong operational capabilities that can sustain development. Simultaneously, invest with a margin of safety, meaning buying cheap. We'll cover these 2 points in detail in parts 2 and 3 later. After selecting and buying stocks, the value investing principle is long-term holding. Investors need a shareholder mindset with patience and persistence, because realizing company value takes time in reality. Does long-term investing mean you can't sell after buying? Not exactly. There are 3 situations when you should sell. First, realizing you were wrong and didn't buy a good company. Second, when circumstances significantly change, like deterioration in company fundamentals, or when stock price far exceeds intrinsic value. Third, finding better investment opportunities or needing to adjust when a stock position becomes too large. The author believes you should patiently hold except in these 3 situations. That concludes the core concepts of value investing. This will cover part 2, how to analyze company fundamentals. Peter Lynch said, Buying stocks without researching fundamentals is like playing cards without looking at your hand. Low odds of winning. Many investors' biggest mistake is ignoring fundamentals, just chasing stories and concepts, fantasizing about finding the next Tencent or Alibaba. Actually, that probability is extremely small. The author advises abandoning these illusions and using comprehensive fundamental analysis to judge investment worthiness. Fundamental analysis includes three aspects: analyzing competitive advantages, financial statements, and management or operations. Sounds pretty professional. Don't worry, let's do a hypothetical scenario to help you understand. Suppose a friend opened a bakery and wants you to invest. How would you consider it? First, you'd find out how much capital this bakery needs and what's the market demand for its products. Can this shop truly attract consumers? Second, you'd also consider the owner's management skills, the team, and if there are strong competitors, what makes this shop better than its competitors? And a series of other questions. Actually, analyzing a listed company's fundamentals isn't fundamentally different from considering investing in a bakery, just more complex. But no problem, we can simplify complexity by focusing on one principle mentioned earlier. That principle is to look for companies with strong competitive advantages, meaning we focus on analyzing the listed company's competitive advantages. So how do we analyze? There are 4 steps. First, assess the company's profitability. Second, examine the source of its profitability. Third, analyze how long it can last. Fourth, examine the industry conditions. Now I'll explain each in detail. First, assessing the company's profitability. If you find a company has consistently been profitable historically, it suggests it might have some competitive advantage.
To judge profitability, examine 4 financial metrics. Free cash flow equals operating cash flow minus capital expenditures. Net profit margin equals net profit divided by revenue. Return on equity, ROE, equals net profit divided by total equity. Return on assets, ROA, equals net profit divided by total assets.
Simply put, a company's production-generated revenue is partly used for operational expenses, partly for reinvestment, and the remainder is free cash flow. This is fully discretionary capital for shareholder dividends or stock buybacks. Warren Buffett highly values this free cash flow metric. If you find a company's free cash flow exceeds 5% of sales revenue, you might have found a money printing machine. Net profit margin refers to net profit as a percentage of net revenue. Consistently above 15% indicates good profitability. In comparison, the average net profit margin of A-share listed companies in China is currently below 8%. Return on equity, ROE, refers to the percentage of a company's net profit relative to its net assets. Generally, if a company consistently achieves return on equity above 15% for multiple years, it usually indicates strong value creation capabilities.
For comparison, the average ROE of A-share listed companies in China is currently below 7%.
Return on assets, ROA, refers to the percentage of a company's net profit relative to its total assets, with 6% to 7% typically serving as an average benchmark. If a company's ROA consistently exceeds this ratio, it suggests potential competitive advantages over peers. For comparison, the average ROA of A-share listed companies in China is only about 5%. That covers the 4 financial metrics. In investment practice, we can use these 4 metrics to quickly screen stocks. Many stock software have screening functions where we can set these metrics as filters to identify companies meeting or exceeding benchmarks, quickly narrowing down competitive candidates. We can set by slowing down competitive candidates. The second step is examining the source of a company's profitability. In other words, how does the company actually make this money? This essentially investigates the source of competitive advantage. Competitive advantages mainly come from 5 sources. First, product differentiation. Second, brand strength. Third, low cost. Fourth, high customer switching costs. Fifth, high competitive barriers. First, product differentiation. Offering unique products that competitors struggle to imitate, like Apple's distinct system design and user experience in Mac, iPad, and iPhone compared to alternatives. D. Apple has built its competitive advantage this way. The second source is strong branding. Great brands persistently occupy consumer minds, strengthen product identification, and increase purchase willingness. Coca-Cola, Nike, and Mute's advantages all stem from powerful branding. The third source is cost capability, delivering equivalent products and services at lower costs than competitors. Companies achieve this through improved production processes or economies of scale. For example, Southwest Airlines uses low-cost aircraft and provides high-standard, no-frills service, making its route costs 25% lower than other airlines. This innovation rewrote the history of the U.S. airline industry. From its 1980 IPO to 2018, Southwest Airlines' stock price rose over 200-fold. The fourth source of competitive advantage is high customer switching costs. It means after using one company's product, consumers find it hard to switch due to monetary or time costs. For instance, a company producing orthopedic medical devices sells artificial joints to hospitals. Surgeons typically require significant training to master implanting these products, but products from different manufacturers vary, meaning switching brands requires retraining, greatly increasing switching costs. Hence, hospitals rarely change orthopedic suppliers. The fifth source is high competitive barriers. The author states that exclusive rights, patents, or network effects create barriers keeping competitors out. Exclusive rights and patent barriers are straightforward. What does network effect mean? It means more users attract even more users, like Taobao and WeChat, which exhibit classic network effects. Industry-specific insight, network effects are the most typical competitive barrier, often leading to winner-takes-all outcomes. Step 3 in analyzing competitive advantage is assessing its duration. We live in an era of rapid technological change. Generally, advantages from product or tech differentiation are relatively short-lived, whereas advantages from low costs, strong brands, high switching costs, and high barriers tend to last longer. For example, Mutai's competitive advantage is significantly more durable than a tech company in electronics. The final step is examining the industry's attributes and development stage, which determine growth potential. For instance, some industries have stable competitive landscapes, leaving little room for latecomers. Some industries are still in a warring states phase, potentially producing dark horses. Similarly, industries in rapid growth phase give companies strong momentum, while industries hitting their ceiling will see slowed company growth. All right, that concludes part 2. Let's briefly summarize competitive advantage analysis. Step 1. Assess if a company has competitive advantages using financial metrics. Step 2. Identify the source of advantages. The author lists 5 sources. Step 3. Examine advantage sustainability. Step 4. Analyze the industry to determine growth potential.
Now consider, after finding a good company through fundamental analysis, what price should we buy at?
This requires company valuation, which brings us to part 3. A common investor mistake is neglecting valuation. Without knowing a company's true worth, you can't judge if its stock is overpriced or underpriced, nor assess potential risks or returns. The author warns, don't expect someone else to buy your shares at higher prices later. Playing this hot potato game often leaves you as the fool holding the bag.
So even good companies require reasonable entry prices. Hence, valuation is essential.
There are 2 main valuation methods. First, discounting future free cash flows. John Burr Williams stated in his 1938 Theory of Investment Value, a stock's worth equals its discounted future cash flows. So what's discounted cash flow? Simply put, discount each future earnings amount to today's value, then sum them for intrinsic value.
The discount size depends on 2 factors.
First, interest rates. Higher rates mean higher present values for future cash. Second, time later cash flows get discounted more heavily.
Of course, precisely calculating intrinsic value is quite complex.
Even Warren Buffett, the stock god, admits he can't value many companies' stocks. because understanding those companies exceeds his ability, mainly since predicting, future cash flow is full of variables. But it's okay, as Buffett says. In investing, being roughly right beats being precisely wrong. We can start with a rough estimate. Based on discounted cash flow principles, 3 key points emerge. First, higher profits mean higher valuations. Second, longer profitability duration leads to higher valuations. Third, lower future operational risk means higher valuations.
Therefore, in practice, we can roughly judge valuations using these 3 points.
Of course, more precise calculations aren't hard. Many stock software can help, but always discount the valuation result. This is what's called setting a margin of safety. The goal is to avoid optimism, misjudgment, and overestimating stock value. At Morningstar, where the author works, they typically set a 20% margin for stable companies with strong advantages, meaning an 80% discount. For high-risk companies without advantages, set it at 60%, a 40% discount. On average, a 60% to 70% discount is suitable for most companies. All right, that's it for the first valuation method. Next, we introduce the second method. Using relative valuation metrics like PE ratio, PB ratio, PS ratio, and PEE, we'll focus on price to earnings and price to book ratios. Price to earnings is a multiple from dividing stock price by earnings per share. For example, if a stock costs 50 yuan per share with 2 yuan annual earnings per share, its price to earnings ratio is 25 times.
There are 2 ways to use PEE. Compare to industry or market averages. A low PEE often suggests undervaluation, but this isn't absolute.
In practice, you must consider 3 factors: company risk, growth potential, and capital needs. In summary, high-growth companies should have a higher price-to-earnings ratio. High-risk companies should have lower price-to-earnings ratios, and companies with higher capital needs will have lower price-to-earnings ratios. So we can't simplistically say low price-to-earnings stocks are cheap and high price-to-earnings stocks are expensive. The second method compares to the stock's own historical levels. If a company with long-term stable operations has a price-to-earnings ratio significantly below its historical average, investigate possible reasons. Investment opportunities might be hidden here. Overall, P/E ratios are intuitive and easy to calculate, suitable for established companies but less useful for young firms with uncertain prospects. Another common valuation metric is the price-to-book ratio, PB ratio. PB ratio is a multiple derived from dividing stock price by net assets per share. P&B works well for capital-intensive industries and finance, but less for service sectors or innovative companies.
Typically, heavy asset industries and banking have reasonable PB between 1 to 2, but many Chinese banks trade below 1.
This reflects market concerns about asset quality. Using PB requires careful examination of true net asset value. For example, if a listed company pays 1 billion yuan for an acquisition with only 300 million in net assets, the extra 700 million becomes goodwill on the balance sheet. But if post-acquisition performance disappoints, that goodwill may face impairment or write-offs. Thus, excessive goodwill distorts reported net assets, making PB ratios misleading. In early 2019, many A-share companies unexpectedly reported massive goodwill impairments, causing huge losses and stock crashes with severe market impact. Okay, that concludes part 3 on company valuation methods. Use multiple valuation methods for comprehensive analysis to better judge company value. Now we enter part 4, key investment considerations for major industries. In this book, the author presents Morningstar's industry research findings, covering research approaches and key factors for 13 industries. Analyzing this content helps investors understand how industries create competitive advantages and how these strategies function. I'll focus on 3 major industries: pharmaceuticals, consumer goods, and banking. Pharmaceuticals easily produce star stocks. Its core competitiveness lies in new drug R&D capabilities. Though drug R&D is time-consuming, costly, and risky, companies without innovation have no long-term future. Thus, invest in pharma firms with sustainable R&D and innovation capabilities.
Also, closely monitor government healthcare policies. Changes in insurance or drug regulations can reshape competition.
This advice from U.S. pharma research equally applies to China's pharmaceutical investments. For example, China's 2018 centralized procurement policy slashed drug prices, profoundly impacting company revenues.
Consequently, a share pharma stocks plummeted across the board.
The second star stock producing industry is consumer goods.
When evaluating consumer goods companies, focus on 4 key traits. First, market share. Generally, high share leaders are better positioned to maintain dominance. Second, free cash flow. Mature consumer firms generate substantial cash for dividends or buybacks, becoming stable investments. Third, brand power emphasis. Companies with strong brand influence, for example, Coca-Cola, Pepsi, Nike, Adidas, have clear advantages. Fourth, innovation. Prioritize firms with consistent product innovation, especially those dominating market share with innovations like Gillette or Apple. Finally, banking, a crucial global economic sector with high investor attention. Warren Buffett's portfolio has long held significant positions in bank stocks. Banks' profit model is simple. First, they take money from depositors or capital markets and lend it to borrowers for interest spreads.
The second part involves charging various intermediary service fees.
The banking industry's core function is risk management, covering 3 types: credit risk, liquidity risk, and interest rate risk. Successful banks share 4 characteristics. First, strong capital foundations for risk resilience. Second, good return on equity, ROE, and return on assets, ROA. Consistent ROE of 15 to 20%, with ROA around 1.2 to 1.4% indicates strong profitability. Third, high management efficiency, reflected in low operating expense ratios. Fourth, substantial and diversified revenue streams. Additionally, price-to-book ratio is particularly useful for bank valuation. All right, that concludes our interpretation of the 5 rules for successful stock investing. To briefly recap, the author uses value investing principles to solve the stock selection challenge. He advocates analyzing fundamentals and intrinsic value, understanding competitive environments, and making rational decisions. By persistently applying this framework and learning from experience, you'll make fewer mistakes and become a better investor. In this sense, the 5 rules can transform an investor's destiny. Finally, the author advises against market timing. Don't try to predict peaks or bottoms. Morningstar's 20-year study of thousands of funds found none consistently timed markets correctly.
Long-term evidence shows timing strategies fail. Focus instead on fundamental and valuation analysis.
Okay, that's our interpretation of the 5 rules for successful stock investing. Reading notes are below the audio. See you next time.